Good day. Today, we are comparing two of Australia's most popular ETFs, A200 and VAS. Which one suits your investing goals best? Let's break it down with simple animations. A200 tracks the top 200 companies on the ASX, while VAS tracks the top 300. That means VAS includes a few more small and mid-cap companies for broader diversification. Both ETFs cover major sectors like banks, mining, and healthcare. But VAS's extra 100 companies add a bit more variety, especially in smaller companies. A200 has a slightly lower management fee at 0.04% per year compared to VAS's 0.07%. While small, fees can add up over time. Let's see how A200 and VAS have performed over the years. If you invested $10,000 5 years ago, both ETFs would have grown your money significantly, but with some small differences. Over the last year, A200 returned about 13%, just ahead of VAS at 12%. Over 3 and 5 years, A200 has also edged out VAS by a small margin, about 0.2% to 0.4% higher per year. But both have delivered strong, steady growth for Aussie investors. Both ETFs track the Australian market closely, so their performance moves almost in sync, especially during big market swings like the COVID crash and recovery. The main reason A200 edges ahead is its slightly lower fee, just 0.04% compared to VAS's 0.07%. Over the long run, lower fees can make a real difference to your total returns. Both ETFs share almost the same top 10 holdings, including big names like Commonwealth Bank, BHP, and CSL, making them very similar in quality. Both pay quarterly dividends with franking credits, providing steady income for investors. If you want slightly lower fees and a focus on the largest 200 companies, A200 might suit you. But if you prefer broader diversification, including more small caps, VAS is a great choice. Remember, this video is for education only, not financial advice. Always do your own research or talk to a licensed advisor. If you found this helpful, hit like, comment your questions, and subscribe for more Aussie ETF guides.